In this topic number 1, on introduction to accounting, we need to understand certain concepts. We need to understand certain areas as far as accounting is concerned. And to start us off, we need to know what is the meaning of accounting. The meaning of accounting. Generally, accounting is normally regarded as the language of the business. We normally take it to be the language of the business. And when we say that accounting is regarded as the language of the business, we are simply trying to say that we are going to use accounting as a way of communicating, because we normally use our languages for communication purpose. Similarly, in any business setup, any financial information regarding a particular business or institution can only be passed to the users of accounting information by preparing the books of accounts. If you want to know how a particular business or institution is performing, you can only be able to do so by reading their books of accounts. So the books of accounts will communicate to you. So they will act as a language in which you are going to understand how the business is performing on financial matters. That's why we are saying it is the language, because it is going to be communicating. If I want to know how a particular business is performing, what are the resources that it owns, what are the liabilities that it has, and all that, I'm going to get all that information by reading the books of accounts. So the books of accounts will communicate to me. So they will act as a language through which I'm going to be able to understand all the financial aspects regarding a particular business entity. That's why it is the language of the business. But on a specific note, we normally say that accounting is the process. Accounting is the process. And when we say that it is the process, it simply means that to prepare these books of accounts, it is not something that you are going to do once. It is not a one-time activity. It undergoes a process of some stages. And this process entails, number 1, identifying. Accounting is the process. The process, it is the stages. The stages here, number 1 will be the stage of identifying. What are we identifying? Here, we are simply saying that when a business is running its activities, so many activities will be done. So many activities will be witnessed, but not all the activities will be recorded in the books of accounts. Some will be recorded because of their impact, and some will not be recorded because they don't have any impact. The process of sorting out what is to be recorded from what is not going to be recorded is what we normally say that it is stage number 1, which is identifying. A customer just comes and asks for the price of the commodity. That is not good enough to record in the books of accounts. It does not have any significant impact to be recorded. We just read it. But a business can buy stock. That is important to be recorded. A business can acquire a motor vehicle. It is important to be recorded. A business can borrow a loan. That is important to be recorded. So the aspect of sorting out what is to be recorded from what is not worth to be recorded is identifying, and it is the stage number 1 in the process. After you have done the identification, then you go to the stage of measuring. After you have identified, you measure. To measure here is simply to quantify the value of the transaction in monetary terms. Yes, you have bought stock. Very important to be recorded. The next question is this stock worth how much? You measure it in monetary terms. Because in accounting, it is only going to consider only the transactions which can be reported in monetary terms. You have bought a motor vehicle, good enough. The motor vehicle is worth how much? You have acquired a loan of how much? Everything must be measured in monetary terms. You identify the transaction, then you report that transaction in monetary terms. After you have measured, then you proceed to the stage number 3. The stage number 3 is summarizing. Summarizing. You summarize. These books of accounts that we are talking about, which are going to be used for communication purpose, they are normally prepared at the end of a financial year. We don't prepare books of accounts on a daily basis. The books of accounts are prepared at the end of a financial year, and a financial year is normally a period of 12 months. So what occurred from the month number 1 to the 12th month, all that information is going to be summarized and then reported in the books of accounts. So similar transactions that have occurred throughout the financial year are going to be summarized. You bought stock, you have been buying stock all through. So at the end of the year, you need to report all the entire year you bought stock of how much. You summarize all the purchases of inventory and report as one figure. You have been making sales. So all the sales that you have been making the entire year, you report it as one figure. You summarize it. You have been selling goods on credit. All those customers who bought goods on credit from your business, you are going to sum them up and then you report as a single figure. You summarize all the transactions that have occurred in that particular financial year. After you have done a summary, that is when now you go to the last stage in the process, which is now communicating. And the communicating now will entail you prepare the final books of accounts. What we normally see as published financial statements. Especially for the listed or limited companies, it is mandatory or it is actually a law that at the end of every financial year, you need to publish your financial reports so that the members of the public can be able to know how you are performing, to enable them be able to know whether to invest in your company, to dispose the shares and all that. So what we normally read as financial reports or financial statements, those are now the reports that are going to be used for communicating. So communicating in accounting is normally done by preparing the final books of accounts. Those are now the documents that we shall issue to the users of accounting information so that they can be able to use that information to make certain decisions regarding your business. So this is now the definition of accounting. That accounting is the process of identifying, measuring, summarizing, and communicating financial information, not any information, financial information to the end users to enable them make informed decisions. To communicate financial information to the end users to enable them make informed decisions concerning the business. That is now the meaning of accounting. That is the meaning of accounting. After we have understood what accounting is, then we need to go to, this is number 1 under the topic. You need to know the meaning. After you have understood the meaning, you go to number 2, where you are supposed now to look at the objectives. Objectives of accounting. Objectives of accounting. Why should we have accounting in our business organizations? What role does it serve? What importance does it serve to business organizations and also to those people who are now going to use that information? The objectives of accounting are actually 5 of them, where number 1 is to enable systematic recording of transactions. systematic recording of transactions. I have indicated that communication is normally done by preparing the books of accounts. Communication is normally done by preparing the books of accounts. Sometimes we call them the financial reports. Sometimes we call them the financial statements. These books of accounts or the financial statements, we have also agreed that they are normally prepared at the end of a financial year, which is a summary of all the transactions that have occurred in a particular financial year. Because it is going to be a summary of the transaction for the entire year, then you'll agree with me. Those transactions, as they occur from the start of the year, they need to be properly recorded so that at the end of the year, when we want to summarize all of them, we can be able to retrieve each and every transaction. We can be able to involve each and every transaction in preparing the books of accounts without any omission. Otherwise, if these transactions are not properly kept, they are not properly recorded, they are not systematically recorded, by the end of the financial year, some of these transactions will not be traced. Some of these transactions are going to be missing. And then when we are doing summarizing and communicating, we shall be summarizing and communicating incomplete information about how the business performed in that particular financial year. But with accounting, every transaction that occurs, it is properly recorded, properly kept. By the end of the year, that particular information can be retrieved, it can be accessed, and then summarizing and communicating will be done, and then we are going to prepare the books of accounts which are complete and which are accurate. That is the first objective, systematic recording of transactions, so that all the transactions can be well kept, they can be retrieved, they can be involved in summarizing and communication of the financial information. That is objective number one. Objective number two is the ascertainment of business performance. Ascertainment of business performance. Any business organization is normally established with the aim of making profit. All business organizations, they are normally established with the sole aim of maximizing the profit. So therefore, the performance of the business in this case, it is the amount of profit the business is able to generate. Accounting serves a role in determining how much profit a particular business was able to realize in a particular financial year by preparing one of the books of accounts known as the income statement, previously known as the trading profit and loss account. So through accounting, we are able to prepare the income statement. The income statement will simply contain the summary of all the income that we generated versus all the costs or expenses that we incurred in that particular financial year, so that now we can compare the income versus the expenses and then determine whether we were able to make the profit or loss and of how much. And that profit or loss is now the performance of that particular business. So accounting also plays a role in determining the performance of the business in terms of profitability through the preparation of the income statement. And I've just indicated that an income statement is simply a statement that will contain incomes versus the expenses that were involved in the operation of the business in that particular financial year. That is the second objective. Objective number three is the ascertainment of financial position. Ascertainment of financial position. The financial position of a business, or if I can start with an individual, you as an individual, if you want to know your financial position right now, you will simply consider all the resources that you own. All the resources that you own, that simply means that the physical assets, the land, buildings, and all that, furnitures, whatever you have or whatever you own, you compare with the liabilities or the debts that you owe others or other institutions like the banks in form of a loan. So if you take all the resources that you own, you add their value in monetary terms, then you repay all the liabilities that you owe others. What remains becomes your financial position. If I have got resources worth 1 million, I have got liabilities worth 400,000. Therefore, my financial position is 1 million minus 400,000, which is 600. Similarly, a business will be able to know its financial position through accounting. What are the resources that the business owns? It has land and buildings, it has motor vehicles, it has inventory, it has cash balance in the bank, it has cash in hand in the petty cash. All those resources, if we add them, and then we pay all the liabilities that we have, what remains is the financial position. So accounting will be able to determine that again by preparing another book of account or financial statement, which we call the statement of financial position, previously known as the balance sheet. Previously known as the balance sheet. So whereby we add all the resources, that is the value as at the end of the year. Then we consider all the liabilities, and then we can be able to know the financial position of that particular business entity. Objective number 4 is determining liquidity and solvency position. Determining the liquidity and solvency position. When I'm talking about liquidity here, I mean we are trying to measure the ability of the business to pay its short-term debts, its short-term financial obligations. The ability of the business to pay its short-term financial obligation in good time, then that business is, if it is able to do so, we normally say that it is liquid. If as a business we are able to pay our suppliers in good time, we are able to pay the salaries and wages in good time, we are also going to be able to pay all the expenses as they arise in good time. If that is the case, then our business has got a good liquidity position. So we normally compare the short-term assets, those assets that are going to be the business for a short period of time, versus those costs or liabilities that are also short-term. So are the resources which are short-term enough to cover the short-term expenses that we are supposed to pay, or the short-term liabilities as they arise? If that is the case, if we are able to sort our short-term liabilities or expenses as they arise, then as a business, we don't have liquidity challenges. But if we are struggling, then our liquidity position is not good. On the other side, we have the solvency. The solvency here is the long-term financial stability of the business. Are we able to pay the long-term liabilities or debts as they arise? If that is the case, then we are solvent. Our solvency position is okay. So through accounting, again, we are able to measure our liquidity and our solvency position as a business. And then last objective is the objective of providing information to end users for decision making. Providing information to the end users for decision making. Accounting, we have said, it is the language of the business. It communicates. And it communicates financial information to these people we are calling the users, which can be individuals or institutions which want to know how the business is performing and therefore be able to know how to relate with the business. So when we are talking about the users, actually that is where we are heading next. These are any individuals or any institutions which might need to know how we are performing. They want to know how we are performing so that they can be able to make certain decisions regarding our business. It can be investors. They want to invest in our business. Before they invest, they must know how we are performing. It can be the lenders. Before they give us loan, they must know how we are performing. All that information they will get from the books of accounts. So accounting will be able now to provide these users with the crucial information that they need so that they can be able to make informed decisions on whether to make certain decision or not regarding the business. Those are the objectives of accounting in business organization. Any question up to that point? Okay, it seems everything is going nicely. Then, after we have understood now the objectives of accounting, I need now to take you through the users of accounting information. Users of accounting information. We are saying that accounting is meant to communicate. To communicate to who? To the users. Number 3, users of accounting. Users of accounting information. Basically, the user is any individual or any party or institution which will require to know how we are performing as a business. Anybody who would be interested to ask for our financial reports or the books of accounts becomes a user. Anybody who is going to go and open our website to read the published financial statements there and all that becomes the user. As long as you are interested in knowing how a business is performing, you are a user of the accounting information of that particular business organization. These users are classified into 2 categories. We have those users we call internal. We have those users we call external. Internal versus external users of accounting information. I will start with the internal users. For the internal users, these are individuals or parties who are simply within the business. They are within the same business. So they are interested in knowing how the business is performing because of certain actually things that they want to decide on. One of these internal users, they are the shareholders. The shareholders are simply the owners of the business. The owners of the business. They are internal users because they are just within the business. In this case, when this question is tested, they will simply ask you for the user and their financial needs. What do they need to know about the business? Why are they reading the books of accounts? So the shareholders, you know, they have invested their resources in the business. At the end of the year, they need returns on their investments. They need dividends. They need their interest. So these people, they want to know the performance of the business. From the performance of the business, they can be able to know the expected returns on the investment. So they want to know the performance so that they can be able to know how much they expect as returns on their investments in terms of dividends, in terms of interest, and any other way the business is going to reward them. That's that. Number 2, it is the management. The management of the business. In most cases, the shareholders are not the managers. The shareholders are not involved in running the business. They delegate that particular responsibility to the management, especially for big businesses like the companies. You are a shareholder, but you don't take part in running the business. So we have the CEO We have the managing directors, the board of directors who are managing the business on behalf of the shareholders. That is the team we are talking about here as the management. These people will also be interested in reading the books of accounts the moment the financial year comes to an end. They want to know how the business is performing because the business is normally run using the policies that they have put in place. So these people, they want to know the performance of the business and therefore be able to know whether the policies and the strategies that they have put in place are working, and if there is need to change those strategies or maintain them depending on the performance. If the performance is okay, we maintain the strategy. If the performance is not okay, then we need to review and adjust those particular policies and strategies that we are using to run that particular business entity. That is the management. Lastly, under the internal, we have the employees. The employees. The employees are simply the people who are working for that particular business organization. These people, their interest is to know the performance of the business to enable them know whether their jobs are secure. They are working for the organization, yes, but the performance of the business is going to dictate whether they are going to continue serving the business, because if the performance is poor, then there is a high likelihood that the business will shut down. If the business is making losses every year, it will shut down. We have seen organizations shutting down, and then the employees are simply rendered jobless or unemployed. So these people are interested to know the performance of the business so that they can be able to know whether their jobs are secure or not. Those three are the internal users of accounting information. Then on the other side, we have the external users. Those are parties or individuals who are outside the business entity. They include, number one, government. The government. Businesses operate in an environment that is regulated by the government. The government demands taxes from the businesses. So the government will also be reading the books of accounts of business organizations, one, for taxation purpose. Here, when I'm talking about government, I'm talking about government and its agencies. Its agencies include now things like the KRA, things like the NEMA. They are government agencies. They are regulating and monitoring the business organizations and how they are operating because they have interest. So for the government, one, it is going to be reading the books of accounts to be able to know how much tax the business was supposed to remit as taxes. Because the amount of tax that you pay depends on the profit. Tax for the businesses is not constant. It is a percentage of the net profit. And the net profit is what we have said is a performance. And the performance is going to be measured by preparing the books of accounts known as the income statement. So they must read your income statement. The moment they read the income statement, they become the users. So for taxation purpose, to know how much tax the business was supposed to remit. And in other cases, the government also will read the books of accounts to be able to know whether the business is going to be run in accordance with the set regulations, whether it is exploiting the customers or not. After the government, we have the potential investors. The potential investors. Those people want to invest their money in your business organization. Before they invest, they must read the books of accounts of your business to be sure that your business, one, is profitable. It has got a good financial position. The assets are more than the liabilities, that is. And then that those people can be able to invest in your business. Even if it is you, you cannot go and just buy shares in any business. Before you buy, you must investigate how the business is performing. You are going to do so by reading their books of accounts to be able to make that decision as to whether the business is good enough to invest your money in. Number three is the suppliers. The suppliers are those business organizations that are going to supply merchandise or stock to your business organization. For these suppliers to supply merchandise on credit to your business, they must be sure that you have got the ability of repaying them when the repayment period will be due. They must read your books of accounts to know how you are performing so that they can be able to know, yes, if we supply goods worth 1 million to ABC Limited, ABC Limited will be able to pay us after 1 month. Because from the books of accounts, the business is having a good liquidity position. The business is making good profit. It has the ability to pay us, so they supply. But when they read the books of accounts and they find that you are struggling, you are making losses, the current assets are less compared to the current liabilities, then the suppliers will deny you credit purchases or credit sale of goods to your business. Closely related to that, we have the lenders. These are the banks or the microfinance institutions from which you can get financial assistance as a business in form of loans. Before they extend a loan to you, they must be sure that you are able to pay that loan together with the interest when the repayment period will be due. So they will be reading your books of accounts to know your ability to pay them, the principal amount that you borrowed together with the loan when the repayment period will be due. So they will also be users. Then after the lenders, we have the customers. Sometimes we call them the clients. Customers or clients. These are the people or business organizations that we are serving. They are the reasons as to why we are existing. These customers, they will be reading our books of accounts to establish whether we have the ability to continue serving them even in the future. How are we performing? Is this particular customer going to enjoy your services even in the future? Because if you are not performing well, there is high likelihood very soon you will be shutting down the business. But if you are doing very well, you will continue serving them even in the future. Those are the customers or the clients. But when you look at the customers, don't focus on an individual. A customer here can be another business. As a business, we sell goods to another business. So those businesses, they will be affected if we don't supply them. If we are not operating, then they will be affected because the key items that they also sell, they get from out. Then you find that that business will be monitoring us very closely. Look over a case like KPLC and maybe the East African cables. The cables that the KPLC use, maybe they acquire them from the East African cables. Therefore, KPLC will be monitoring the performance of the East African cables because KPLC is a customer to East African cables. If East African cables is not performing, then KPLC will be affected by its operations. So it must monitor. So if they find that you are struggling, they start looking for another source of getting that particular supplies. That is what we are talking about here. Then last, in the external users, we have the public. The others now. The public here, we are talking about the economists, those people who read the books of accounts of businesses to just know the economic performance of the country. We can have the scholars, those people who are undertaking some scholarly work. At one point, you will be doing your research project. If your research project is related to accounting, you might find yourself reading the books of accounts to get data. So you become a user. We also have the society at large, whereby the business has been hosted. The society demands some returns from the business in the form of the corporate social responsibility, giving back to the community. If the business is performing well, the general public or the society will be demanding the return or paying back to the society, assisting the society, paying school fees for the needy, assisting in maintenance of the environment and all that. That is the general public. And these are simply the users of accounting information. So when this question is presented to you in an exam, you should be able to identify these users. You should also be able to explain what they need the accounting information for. Every user has got a specific need that they need to satisfy using the accounting information. If it is government, we have talked about tax. If it is the employees, job security. If the management, to know whether their policies are working. If it is the shareholders, to know the expected returns. If it is the lenders, the ability of the business to pay back the principal amount together with the interest. They have the needs. You should be able to present the needs of each and every user of accounting information. After we have done that, we need now to go to the fourth part, the fourth area that you need to understand on the introduction to accounting topic. The fourth part is about the characteristics of a good accounting information. Characteristics of a good accounting information. Characteristics of a good accounting information. We have said that accounting will provide information to the users. This information that is presented to the users will be helpful to them if it contains certain characteristics. Sometimes we call it the attributes of a good accounting information. So the information is going to assist the users if it has the following characteristics. Number one, it is the timeliness. The characteristics of the timeliness, meaning that a good accounting information should be presented to the users on a timely manner when they require that information to make decisions. The books of accounts are prepared at the end of the year. So once the end of the year has come, then the books of accounts should be prepared immediately so that it can be available to be presented to the users anytime these users will demand for that information. So timeliness. It is not going to make sense. I want to decide whether to invest in the business today because I have extra finances today, but you provide that information after 4 or 5 months. You find that now that information might not help me. The resources that I had to invest in your business, I have already spent on other things. So the information is not helpful to me. Timeliness. Number two is about relevance. The characteristic of relevance. Something that is relevant is something that is going to help you because it has got what you are looking for. So a good accounting information should be able to assist the user of accounting information by providing the information these users are requiring. It should contain what the users are looking for. And actually, we normally say that for information to be relevant, it should assist the user in making or having a feedback. Sorry. And also, it should assist the users by giving a feedback and also assisting that users to predict. feedback here is by getting what you are looking for. I want to know how much profit that you are making as a business. I read your books of account. Am I able to get that information there that you made a profit of 2.5 million? You have already answered me. I have the feedback. The information should also assist me to predict what might happen in the business in the future, especially when I'm given like 3 sets of financial statements for 3 years. I'm given the financial statements for 2022, 2022, 2023, and 2024. By reading the books of accounts there, I should be able to predict or forecast what might happen in the business in the future. Will the profit be increasing? Will the financial position will be improving? And something like that. So it should be able to give me the feedback, what I was looking for, and it should also assist me forecast what might happen in the business in the future. If the information is able to give me the two of them, then that information will be said to be relevant. But on the bottom line, relevant information that will be able to satisfy what you are looking for. Number 3 is the element of consistency. The characteristic of consistency. Accounting information should be prepared in the same manner. The business transactions should be treated in the same manner across the financial years. What we mean here is this. Sometimes the accountants can be presented with more than one option on how to deal with a transaction. If I give an example, we shall be calculating at one point depreciation on fixed assets. Fixed assets are those long-term assets in the business. As they are being used in the business, they lose value, and that value that they lose, we normally say that they have depreciated. The accountant has got like 7 methods of calculating depreciation. We have straight line method, we have reducing balance method, sum of the years method, we also have revaluation method, and others. If as an accountant I've decided to use straight line method, then I should maintain that. Every year, as I calculate depreciation, let me use straight line method. That is consistent. That is consistent. It should not be a case whereby this year I calculate depreciation using reducing balance. Next year I change to straight line. The other year I go to revaluation. That all those books of accounts will lack consistency. Good accounting information is the information that has been prepared in the same way across the financial years. And that information will be good. Number 4, we have the characteristic of comparability. Good accounting information should assist the users in making comparison. A good accounting information should assist the users of that accounting information in making comparison. And when we are talking about comparison here, you shall be talking about intra and intra-business comparison and inter-business comparison. Intra is when you compare the performance of the business within the business itself. That is to say, you are comparing the performance of the same business for different financial years. How did we perform this year? We realized a profit of 2.8 million. What about last year? The profit was 2.6. So you can be able to compare within the business itself, but across different financial years. You are going to do intra-comparison. When we talk about inter-comparison here, it is when you are comparing the performance of the business with your competitors. How did I perform with respect to my competitors? Did I perform better than them? Are we equal the same? Or I performed poorly when I compare with the performance of my competitors? So a good accounting information should assist the user in making comparison. And we normally say that comparability can only happen if there is consistency. So comparability is a subset of consistency. Without consistency, there cannot be comparability. Because when there is no consistency, then you will be having different books of accounts because they are prepared differently. Then you cannot compare things that are different. But when you maintain the same way of preparing the books of accounts, then you are going to have identical or similar books of accounts, which will be easy for your comparison. Another characteristic is reliability. And this is all about information that is trustworthy. A good accounting information should be information that can be trusted, information that is not biased, information which has not been sugar-coated. It has been reported the way things happened. If it is a loss, you report it as a loss. We should not have a case whereby the business incurred a loss, but the accountant is trying to cook figures and then make it appear like it made a profit. That information will lack reliability. And the reliability is normally boosted by having the books of accounts being audited. When they are audited and the auditor stamps that the books of accounts are reflecting the true and correct view of what happened, then we normally say that reliability has been boosted. Reliability has been good. Lastly, it is the characteristic of completeness. Completeness. And we say that a good accounting information should contain all the relevant information it should contain. It should contain all the relevant or material information it should contain without any omission. When you present to me information that is missing some parts, you might find that that information will not be helpful. But when the information is all around, if I needed to know the financial position, I can be able to know that. If I needed to know the profitability, I'm able to get it. Then that information is complete and it is going to be very good for the users of accounting information as they make the decisions. So these are the characteristics or the attributes of a good accounting information. After looking at them, now we can go to the last part on the introduction to accounting, where we are going to talk about the accounting principles and concepts. If you have any question, you are free to object and raise it. Accounting principles and concepts. This is also another area that is highly tested in your exams. And therefore, you need to have a very good understanding at these accounting principles and concepts. Accounting principles and concepts, they are simply guidelines. They are guidelines on how to treat business transactions. They are guidelines on how to treat business transactions as they occur. How to treat the business transactions as they occur. Guidelines. The key word here is that they are guidelines. Sorry. Sorry for that. There are guidelines on how to treat business transactions as they occur in the business. And these guidelines, they are meant to make sure that there is uniformity. They are meant to make sure that there is uniformity. When we have the guidelines, then it simply means that we are being guided. When we are all being guided, then we are going to do things the same way. Otherwise, if we don't have accounting principles and concepts, then this discipline of accounting will be chaotic. Like, for example, we are 27 of us right now. If all of us are presented with accounting information, and then we are told, can we prepare the books of accounts without being guided? It is obvious that the 27 of us will prepare the books of accounts in their own way, using their own judgment, using their own thinking. But when we shall be subjected to the same guidelines, all of us, we are going to do the same thing. We are going to have identical and uniform books of accounts. The 27 of us, we are going to report the same profit. We are going to indicate the same financial position and all that. So similarly, because accounting is a discipline that also requires order, the order is normally made by having the guidelines. What you treat as an expense this year, I also treat it as an expense this year. What I consider that this amount, no. This amount was paid this year, but we should be captured in the next financial year. We should all do the same. So we need guidelines. We can actually also go to a point whereby we say that this information, it is not an information to be reported in the books of accounts. Because maybe it lacks the monetary value. We cannot be able to measure it. Then all of us, we are able to do so. So those guidelines, which are meant to ensure that there is uniformity on how the books of accounts and the business transactions are treated in the books of accounts, are the ones that we are talking about as the accounting principles and concepts. There are like 10 of them. So you need to understand the explanation and the meaning of each one of them. Because in the examination, they will give 5. They have a tendency of testing 5. So out of the 10, they pick 5. And then they tell you, explain the meaning of the following accounting principles and concepts. Then you should be able to know how to explain them. So the accounting principles and concepts are like this, or they are as follows. A, it is the first and basic principle of the money measurement. The money measurement concept. We said that accounting is the process of measuring, of identifying, Dorcas, we shall look at it. I've seen your request. We shall discuss it as we end the class. The money measurement. We said accounting is the process of identifying, measuring, summarizing, and communicating financial information. The key word there was financial. So we are only handling matters to do with money. We are handling only matters to do with the money. So this principle guides that only those transactions which can be expressed in monetary terms should be recorded in the books of accounts. Only the transactions which can be expressed in monetary terms should be recorded in the books of accounts. If they cannot be measured in monetary terms, then we should not record them, because they are not able to be measured financially. So some transactions like a motivation of the employees, we cannot measure them in monetary terms. And because we cannot measure them in monetary terms, you will never find them in the books of accounts. The quality of the product and all that, you will never find them in the books of accounts because they lack money measurement. That is the first and basic principle. Only the transactions which can be expressed in monetary terms are recorded in the books of accounts. Number B is the business entity. The business entity. The business entity states that the owner or owners of the business and the business itself, the owners and the business are considered to be two different parties. The owner and the business are two different parties, whereby the owner's personal transactions cannot be mixed with business transactions. You own a business. So you, the owner, and your business are two distinct parties. At your personal level, you have your own income and you have your own expenses. At the business point of view, it generates its income, it also incurs expenses. Your personal income, you cannot combine it with the business income. That is yours. And your personal expenses, you cannot mix with your business expenses. You cannot actually forward the burden of your personal expenses so that the business can pay for you. That is against the business entity concept. The business and the owners are two distinct parties, and their transactions cannot be combined. They cannot be mixed. They cannot be mixed. If you happen to take something from your business, you should do a honorable thing and pay the business that money. Because the business does not know you as the owner. It will treat you as a customer. Huh? Yes, that is the business entity. If you have given your business some additional money, it is like you have given it a loan. At a future date, the business should be able to refund you that money. That is how we normally view things from the business perspective. Otherwise, if you pay rent and you also have the rent for your business, you cannot take your personal rent and then you take it to be a business expense. You will be affecting the performance of your business. And therefore, when you are reporting the performance of the business, the performance will be low or poor simply because of your personal cost and prices. Number C. Number C is a principle we call going concern. The going concern. The going concern concept. And by going concern is simply an assumption that we make that a business organization will operate. The business organization will operate into foreseeable future. The business organization will operate into foreseeable future or will operate indefinitely. Yeah? That means that the business is assumed that it will operate for a long period of time without shutting down its operations. It will operate for a very, very long period of time without shutting down its operations. That is the business, the going concern concept. The assumption that the business will operate into the foreseeable future indefinitely. We don't know when, but it will operate for a very long period of time. And when a business is operating as a going concern, then you'll find that it is going to be very attractive to the users of accounting information. People or the shareholders will want to maintain their shares. The employees will want to continue working in that particular business. The suppliers will be willing to supply. The lenders will be willing to lend money and all that. Anybody will be very comfortable with that particular when the business is a going concern also, you can be able to go and borrow even a 20-year loan. And it is going to be assumed that the business will still be there after 20 years to pay that loan because you have exhibited that you are a going concern. But that does not mean that businesses don't shut down. Those businesses that shut down, they lacked that going concern aspect. So, but the assumption is that any business organization is going to operate indefinitely into the future. That is the going concern. Then D, we have the matching. The matching concept. And by the matching concept, the explanation is that the revenues, that is income, of a particular business entity should be matched with the expenses for the same period. The revenues for a particular period should be matched with expenses for the same period so that we can get the clear financial performance. If it is revenue for January to April, then give us also the expenses for January to April. If it is revenue from January to December, then give us also the expenses for January to December, so that we can be able to have comparability here. There's no way I can compare revenues for January to December with the expenses of January to October. Obviously, the performance will not be accurate and it will not be okay. It will not be correct. You should match expenses and revenues for the same period of time so that you can get a correct performance of your business. After matching, we have a concept we call accrual. Accrual concept. Under the going concern here, we have said that the business is assumed that it will operate for a long period of time. It has a very long lifespan. But you find that this long period of time is normally subdivided into accounting years. After every 12 months, that is an accounting year. Another 12 months, another accounting year like that. So accounting year is also the same as financial year. So if this is year 1, this is year 2, and then we have year 3. It is very common that you might find that the expenses that were supposed to be paid in year 1, they have been paid in year 2. Those of year 2, they have been paid in year 3. And sometimes the expenses of year 3 has been paid in year 2. We have such kind of cases. A good example is an expense like salary. We normally pay, or most organizations pay their salaries at the start of the next month. Yes, the salaries for January will be paid early February. If the year is coming to an end on that 1st of December, that is the financial year. Financial year 1, ending that 1st of December. You might find that the salaries for December, year 1, are paid in January year 2. Salaries for January year 1 being paid in February, salary for December year 1. December year 1, the salaries are paid in January year 2. You wonder now. The salaries are for year 1, but they have been paid in year 2. And note, every financial year should come with its own financial statements. For year 1, we need to report what was the income in year 1, what was the expenses in year 2. We match, as we have said here. We get the performance. Now, the salaries that have been paid in year 2, but they were for year 1, should we report them in year 2 or should we report them in year 1? Should we include them as expenses for year 2 or expenses for year 1? Who can try that?
Can you repeat that again?
I'm saying there is 31st December. The salaries for December year one. This is year one, December salary. They were December year one. But these salaries, they have been paid here in January year two. Are you going to report them? Remember, I've said every financial year, year one, we are supposed to come up with an income statement for year one, statement of financial position for year one. When we go to year two, income statement for year two, statement of financial position for year two. But here now, the salaries for this December, they are 120,000. Instead of being paid in December, they have been paid in January, but another year. Are you going to incorporate them in the financial statement for year two or financial statements for year one?
Financial year, no.
Year one.
Yeah.
Yes.
Maureen said year one, which is actually correct. These salaries, 120,000, they are salaries for December year one. So they belong to year one. It is a cost of year one. It is not a cost of year two. Even if the payment has been made in year two, we need to report them where they occurred. They occurred in year one. That is what we talk about accrual, which states that expenses and revenues should be recorded in the financial year they occurred and not the financial year they are paid or received. Expenses and revenues should be recorded in the financial year they occurred and not the financial year where payment was made or money was paid or received. That is it. The accrual concept. We normally prepare the financial statement on the basis of accrual. Actually, when we are here, December 22 to December year one, even if those salaries have not been paid, we shall still have to add them to the salaries expenses that we have paid in that year. That is a rule. That is a rule. Don't just say that because we have not paid or we have paid in year two, then the salaries, this 120,000, we are going to consider it as an expense of year two. No, it did not occur in year two. It occurred in year one, only that the payment has been made in year two. We take it back to where it occurred. The accrual concept. Then F, we have what we call the historical cost concept. Sometimes we call it the cost concept. The historical cost normally touches on the items that are said here, known as the fixed assets. The fixed assets, sometimes we call them the non-current. The fixed assets, sometimes we refer to them as the non-current assets. These are long-term assets. Those assets or resources, once you acquire them, the business will enjoy them for a long period of time, a period exceeding one financial year. The computers, the land and the buildings, the equipment, the machines, furniture, and all that in the business. You buy them, they will serve you this year, they will still serve you next year. So they are fixed assets because they are long-term. These assets, because of inflation outside there, after some times, their market price will be changing. You buy a computer at 50,000 today. That computer will serve you this year and maybe the next like 5 years. But after 2 years, the computer that you acquired at 50,000, it is now being sold at 55,000 in the market. The same model with the same specifications. So you bought your, let me go back here. You bought your computer in year one. Then here we have your year 2, year 3. When you bought it, it was having a cost of 50,000. After 2 years here, the cost of that computer in the market is 55,000. You know, the rule is after every financial year, you must prepare the books of accounts. And there is this book of accounts we call the statement of financial position, where we normally record assets, capital, and liabilities. So when you want to state that the business has got a computer, in year 1, we shall say that we have a computer of 50,000. That is the monetary value. That is the value that we have measured. Year 2, maybe it has the same cost, 50,000, but maybe, you know, they depreciate. The value of an asset as you use it does not remain constant. Maybe in year 2, it lost 1,000 depreciation. You find that it has 49,000. Let me start here. Let me start here. You bought it at the start of the year. After using it for that year, because you bought it in January, after using it from January to December, you are it depreciated by 1,000. So the net book value after year 1 is 49,000. In year 2, you report that you have a computer of 50,000. Maybe year 2, it has lost another 1,000. If it has lost another 1,000, and here it lost 1,000, it has lost cumulatively 2,000. Sorry. Then it is misbehaving. Then it's misbehaving. So I'm deducting depreciation. We are assuming that every year it is depreciating by 1,000. So year 1, it lost 1,000. Year 2, it has lost another 1,000. So its value, we shall less 2,000 here. The 2,000 that have deducted here is the depreciation for year 1 plus the depreciation for year 2. 1,000, 1,000, 2,000. So the value here will be 48,000. Now we are in year 3. In year 3, the market price of this particular computer has gone up from 50 to 55. When I want to report now the value of my asset, should I take 55,000 and then I deduct 3,000 depreciation for year 1, year 2, and year 3? Or should I take 50,000 and deduct depreciation for year 1, 2, and 3? The computer that I have will be having a value of how much? Is it 55,000 minus 3,000, which is depreciation of 1,000, 1,000, 1,000? Or is it 50,000 and then I deduct depreciation of 1,000, 1,000, 1,000, which is 3,000? The correct position, I should not use this. The correct position is that I should use my initial cost, the cost that I bought my computer at, and then I deduct my 3,000. To get that, I have a computer of 47. I should not use the current market price. I should always use what we call the historical cost. Historical cost is the cost at which you bought your asset. So to explain that, or to put now an explanation, the historical cost concept simply states that the fixed assets of a business, they should be recorded in the books of accounts at their historical cost. Historical cost, you can put into bracket the purchase cost, and not using the prevailing market price. We should capture them at their historical cost, actually less depreciation, and not using the current market price. We should not focus on the current market price. If my computer was acquired at 50,000, that is my historical cost. So every year, my cost should be 50,000 minus depreciation. Year 2, 50,000 minus total depreciation. Year 3, 50,000 minus depreciation. Year 4, 50,000 minus. We should maintain the historical cost. We should not move to the current market price, because that is not the value of your asset. assets, they should be captured at their historical cost, less depreciation, and not the prevailing market price.
Excuse me, Paulino.
Yes?
How about assets that increase in value, like land?
Yes, those ones we call them, they say they appreciate. It is true, Maureen, that we have got assets, instead of depreciating, they appreciate in value. And a good example is land and buildings. So if they appreciate, we don't calculate depreciation there. We normally do what we call revaluation. Assets that appreciate, we revalue them. We shall revalue them. So we shall go to the initial cost, then we add the amount that they have increased with. Are we together? But you find that they are very rare. When we do it in a class level, actually they will never bring you an asset that is increasing in value. But practically, it is true. Some assets, they increase in value. That is land and buildings. Therefore, how do we account for them? If you bought land at 2 million, 2 years down the line, it has appreciated by 500,000. So what you do, we shall doing the revaluation. So when we are reporting after the 2 years, we shall say that we have land of 2,000 plus the revaluation reserve of 500,000, and then we report 2.5, which will be now that. But we have the basis, the cost. We add the revaluation, but depreciation, we have the cost, we minus the depreciation. Hope that is okay. Then G, we have the materiality. The materiality concept. The materiality concept is very simple also. It says that all the material information must be included in the books of accounts, while immaterial information should be left out from the books of accounts. All the material information here, it is any information that can affect the decision to be made by the user of accounting information. Any information that will affect the decision that you will make. When that information is provided, you will make the decision A. If that information is not provided, you will make decision B. That information is therefore material. Any information that can affect the decision to be made is considered to be material and must be included in the books of accounts. But immaterial information, which is the information, whether given or not given, you will still make the same decision. That information should be left out. It is not having any importance anyway, because at the end of the day, the person will make the same decision, whether given or not given. Material information should be incorporated, while the immaterial information should be left out. Then H, we have prudence, which sometimes we call it conservatism. Prudence or conservatism concept. This particular concept simply says that the assets and revenues. Here we have assets and revenues. On the other side, we have liabilities and expenses. When a business is having assets, more assets and more revenue, that business is going to be doing very well. The same building, the same business will be doing very well if the liabilities and expenses are very low. They are very few. So this concept is all about to guide that. The accountant should not exaggerate the performance of the business by exaggerating the assets and revenues. Assets and revenues, they should not be overstated. They should not be exaggerated, while liabilities and expenses should not be understated. Because when the accountant wants to cook figures, What they will do, they will increase the values of assets and revenues, and then report less of liabilities and expenses. Therefore, the prudence concept simply states that assets and revenues should not be overstated, while liabilities and expenses should not be understated. An asset that you are not sure that you are going to get, you should not actually consider that you are going to have that asset. If, for example, there is money that you feel like it is doubtful to be received, you should not actually consider that money as income in the business. You should not consider it, remove it from the books. So that you are going to have a realistic value of assets and revenues, and then realistic liabilities and expenses. Don't overquote these liabilities and expenses. Make sure then that they are realistic, and also assets and revenues are also realistic, so that you can have a realistic performance of the business that is going to be portrayed by the books of accounts. By the books of accounts, the prudence or conservatism. We should not exaggerate assets and revenues. We should not understate liabilities and expenses, so that we can have a true and correct view of the performance of the business. Then we have another one we call revenue realization. And by revenue realization, it is simply stated that revenue should be considered realized when there is sufficient proof that it has been earned. Revenue should be considered realized when there is sufficient proof it has been earned. The main source of revenue to businesses is normally through sales. You sell items, you generate revenue. So when you say that you have sold an item, there must be sufficient evidence that that item has actually been sold, so that you don't rely on promises. Customer will come, admire your product in the business, and then promise you that this item X, it is so appealing to me, I'll come and buy it end month once I have my salary. You cannot celebrate that that item has been sold. Item X has not been sold by that simple promise. That revenue has not been realized. You cannot come and say that that day I sold item X, because so and so promised to come and buy it end month. No revenue has been realized there. But if the same customer commits him or herself, takes the item on credit, goes with the item with the promise is going to pay end month, you can say that that item has been sold. There is evidence or proof that the item has been sold because it has changed hands. Or if the customer has paid a deposit, you can say that that customer is serious, you have sold that item. But a mere promise that the person will come, that does not guarantee a revenue realization. Revenue realization here, the main source of revenue here when we are talking about revenue is sales. When can you say that sales has been realized? Sales can only be realized when there is sufficient proof that the item has been sold or that revenue has been earned. Today we have a concept we call substance over form. Substance over form. This is a concept whereby the accountants might find themselves maybe at a point of dilemma. These items we call assets. The items we call assets. It is those items which you are actually able to prove that they are your assets. You are actually going to be able to prove that you own them. The items that you can prove that you own them are the assets. Whether it is land, you have the title deed for it. If it is, for example, motor vehicle, you have the logbook. If it is the other assets, you have the receipts that you have acquired them. They are assets. Then we have a scenario whereby these assets can be acquired to the business or they are being used in the business, but the reality is that that asset, you have not actually owned it. This is a case whereby the assets have been acquired through hire purchase. If I can talk about it, you have bought your motor vehicle on hire purchase. How hire purchase works is that you pay the deposit, you get the item, you start using it as you make periodic installments. From the law point of view, the law states that the item that is acquired on hire purchase, its ownership remains with the seller until you, the buyer, pays the last installment. Before you clear the installment, you are using the asset, yes, but it is not legally yours. It belongs to the seller. To you, that asset is only on hire. When you clear the installment, that is when the ownership rights moves to you as the buyer. Now, the accountants, they normally find themselves in a fix. We have acquired a motor vehicle this year. It is on hire purchase. Then the installments for this particular motor vehicle, maybe they stretch for 3 years. We are going to pay maybe the installments for a period of 3 years. The question arises, year 1 and year 2, should we include this motor vehicle as our asset when we are preparing the statement of financial position? I've said when you prepare the statement of financial position, you need to list all the assets that you have and their value. This asset that was acquired by hire purchase, year 1, from the legal point of view, we have not cleared the installments, so it is not our asset. The accountant, is he or she supposed to include that asset in the books of accounts? Anita says no, because legally it is not our asset. The other person will argue, wait, this asset that is on hire purchase, are we using it? The answer is yes. Is it contributing to the revenue? It is yes. Then why should we not include it as our asset? So there is now some forces that says this form here, we are talking about from the angle of the legal. What does the law say? The law says it is not our asset. From the substance here, we are talking about the economic benefit. The other person now will say, is the asset giving the business some economic benefits? Yes, because even if it is on hire purchase, there is no restriction that we should not use it. But now, this particular concept gives an explanation on what should happen when an asset is acquired on hire purchase or through leasing. We should actually go with this. We should not focus on the legal point. We should focus on the economic benefit. And therefore, even if it is not legally ours, we should include it as our asset. We should include it as our asset because the economic benefit supersedes the legal form. The revenue that this asset generated is part of the revenue that we have captured there in the income statement as sales. Then if we have considered the revenue, then why should we not consider this one also to be our asset? That is now the question. And we find that we normally go to this. So a substance over form, the explanation is that assets acquired through hire purchase and leasing they should be considered to be business assets, since the economic benefits, into bracket substance, supersedes the legal form. Supersedes the legal form. They should be captured as business assets because the economic benefits supersedes the legal form. That's it. And then lastly, and this is now where we shall pick from in our next class. It's the last principle. It is known as the dual aspect. Sometimes we call it double entry. The dual aspect or double entry. This concept simply states that for every business transaction that occurs in the business, or for every transaction in the business, two accounts are affected. That is why we call it dual or double. Two accounts are affected. One of which should be debited, and the other one credited. For every business transaction, two accounts are affected. One of which is debited and the other one credited. And when we talk about debiting and credit, an account normally looks like this. We shall be using a capital T. So if, for example, the transaction is that I bought this pen, 100 shillings, and I paid it by cash, two things will be happening. I'm acquiring a pen, I'm giving out 100. And therefore, I should report like that. I should say that a pen has been acquired. I should come here and open an account for pen. I should have another account for cash. I should report that I have spent 100. I should report that I have acquired a pen of 100. That is the double entry, whereby now I'm going to teach you and as to how we debit and credit the accounts, depending on how they are. So the two accounts, that is the double entry. This 100 shillings has been entered here, it has been entered here. This means that I have given out cash, there is decrease in cash, there is increase in the pens. If I had other pens, I have acquired another one. That is what we call double entry. But it simply states that for every business transaction, two accounts are affected, one of which is debited and the other one is credited. You cannot credit both of them. You cannot debit both of them. It is always debit credit. If this one was debited, this one is credited. If this one is debited, this one is credited. They go like that. In simple terms, we also say that for every debit entry, there must be a corresponding credit entry. That is double entry. You buy a car by loan, you must report that you have a car. You must report that you have a loan. Double entry. You deposit money from cash to bank, you must report that there is cash outflow and there is increase in bank balance. You must have double entry. There is no transaction that can only have one effect. It must, or they must have two effects. As long as there are transactions involving money, they must affect you. You buy stock, you must indicate that there is increase in stock. You must indicate that you have spent money. If you buy it on credit, you must indicate that you have received the stock. You must indicate that you have a debt to pay, a liability. If you acquired the stock on credit, that is the double entry. And this is where we shall start from in our next class. So for those maybe who joined slightly late, we made a communication that this unit is a bit wide. Actually, it is wide. We need to have an additional class, and the college has given us the permission, I and Mr. Ezra, who is taking the evening class, to have a Sunday class. Sunday evening, we have agreed from around 4:30 there. but we shall be now making the communication on our WhatsApp groups. So just have it in mind that we shall be having that class. I know it is a sacrifice. It is also a sacrifice from us because we don't have otherwise. By the time
Sorry.
this exam is done,
Excuse me, sorry, I didn't get the second class will be when?
Sunday,
Sunday. Okay.
yes. It cannot be placed anywhere. If we try to place it anywhere else, you will find that some will be having another class, some are free. We have tried it and it has not worked. So it's the only time all of you are free. It is that Sunday from around 4 p.m. 2 hours or 1.5 hours will be enough for us. So kindly create a provision of time for that. I know weekend you normally have it as yes.
So
Janet?
apart from this class, so we'll be having 2 classes in a week.
Yes, exactly. So that this unit can be managed. We do accounting, we do the financial management. We should be having 2. And the Sunday is not a addition, it is a continuation class. It is a continuation class. That is